If you're looking for a head start on what's going to be happening with the stock market next week, opening on what is it? Let's see, June 22nd. June 22nd, Monday, June 22nd, okay? When the market opens back up and you want to be ready for it, right? Watch this video. This video is going to be for you. I'm going to share with you all some insights on what you should be keeping your eye on, especially if you're interested in the AI stock trading, right? I mean, I'm talking NVIDIA, I'm talking Qualcomm, I'm talking Marvell, I'm talking Micron, I'm talking SanDisk, I'm talking Intel, okay? If you're interested in any of the semiconductor stocks, all the stocks that are leading this race right here, I mean, you've got to watch this right here. If you're interested in Google, Microsoft, Tesla, what we used to call the Mag 7, okay, watch this video. Okay, so a few different things has happened recently, right? We had Kevin Warsh stepped in as the Fed Reserve Chair. Of course, he's changing things up real quickly here. Everybody's watching to see what he's going to do and anticipating so that they can be ahead of the curve, right? Don't we want to be ahead of the curve when we're trading and when we're investing, right? That you got to have the information to be ahead of the curve. All right, and then on top of that, I'm going to share another article from Kate Rooney, CNBC, based on the AI borrowing and stuff like that. Which there's been a lot of capex, a lot of spending to build out this AI world that we need, and then of course some insights from the Qualcomm CEO on some of the cool devices, gadgets that are going to be coming out. Right? I mean, that's going to change the trade world as well. That's going to create some catalysts. All right, so let's dive right into it. First thing is this uh, article right here from Felix Vizina Poirier. All right. Opinion: the Fed is forcing Wall Street to do the heavy lifting. Use these benchmarks to find your footing. Okay. So, of course, as I mentioned before, right, Kevin Warsh stepped in. The Fed's looking really different now. I'm going to read a few things right here for us. Okay. The Federal Reserve meeting this week marked the beginning of a new era for U.S. monetary policy and consequently for investors. Evidently, okay. I mean, the market has already changed with Kevin Warsh after his press meeting. I mean, there was a sell-off. It gradually climbed back up a little bit, but nonetheless, right? I mean, there was reaction to it. At Wednesday's meeting, new Fed Chair Kevin Warsh gave investors the real clue about his plans for the central bank: speak less, guide less, and force markets to do more of the work. Now, if you haven't seen my video in reaction to what happened after the Fed meeting, press release by Kevin Warsh, okay, that's a I mean, my take on it was Kevin Warsh was being quite intentional about what he wanted to do, how he wanted to change the leadership style of the Federal Reserve. Okay, nonetheless, right? I mean, in my opinion, he was put in place to do one thing, which is to drop rates, and of course, obviously, provide a better economy for help provide a better economy for Americans, right? Us here living, and we want a great opportunity to build wealth here. So, anyways, speak less, guide less. I mean, that's essentially what he had mentioned, right? That he doesn't want to provide uh, guidance based off of their conversations and their meetings and things like that to kind of misguide the market a little bit because the market tends to react. I believe how he feels about it is it's a little you know unintentional when they make those type of moves based off of the remarks from Fed meetings. Anyways, the first signals here. Okay, so far the major change is more sparse communication. Fed policy statement was significantly trimmed, left with just facts, as Warsh had said, right? And I had mentioned that already. That's the main thing. Let's see right here. Goodbye to guidance. There's more. There's an important nuance to the changes Warsh has made to Fed communications so far. While explicit guidance was removed, some implicit guidance remained as the inflation was prioritized over employment. This matters. The Fed can ditch explicit guidance, but it can't ditch risk management. The most important intellectual work done by central banks is risk management. Monetary policy does not depend only on theory of growth and inflation. It also weighs upsides and down risks. So, I'm gonna wrap this article up with the investment implications right here. Okay, so this guy right here, Felix, is saying expect more market volatility around economic data releases, especially for major releases such as the employment or inflation reports. I see where he's coming from with this, right? I wouldn't say more market volatility, right? I mean, I think that in my opinion, we've already been anticipating and keeping a close eye on. And if you haven't, right, keep a close eye on any of these economic data reports. And there's already been reactions on a regular basis. The only thing different, in my opinion, is that investors, especially institutional investors, haven't been setting up their investments around the guidance, forward guidance, which is like the news that, whatever the Federal Reserve has been sharing on their outlook of what's going to happen with the economy. So at the end of the day, I still look at this right here. Any type of data release is still kind of, it acts as a potential catalyst. So that's my look on it. Okay, same thing as an earnings call. That's my take. So let's go ahead and move into the next article here. This one right here is from Kate Rooney. She's from CNBC. She's one of the journalists there, right? I'm going to hit these 3 key points here. Tech giants are depleting reserves and leveraging debt in their ambitious data center build-outs. I mean, that's if you've been following the market, that's exactly what's been going on. Now, if you're new to this and you're trying to catch up, right? I mean, that's where all the money's been being spent. Okay, all the large companies, Amazon, Google, hyperscalers, right? They've been putting money into the AI build out, tons of it, billions and billions. Next year, it's supposed to be in the trillion. Okay, so that's one thing. That's a given. That's making the group much more exposed to the cost of borrowing and giving tech investors reason to pay attention to the Fed. Now, what Kate is saying there is that um, with more spending, right? Obviously, they've got to borrow this money, okay? And then, of course, borrowed money, we've got to look at the interest rate on borrowed money, and that's gonna impact a lot of investments for sure. Especially, I mean, when you're talking about rates, especially small businesses, and I mean, even the regular consumers out there. So certainly something to keep an eye out on. Tech investors are learning what it's like to be an investor in an old economy, industrial businesses, said Peter Bukvar. Sorry, I butchered that. Chief Investment Officer of One Point BFG Wealth Partners. Okay. So let's get into what Kate is trying to share with us here. Okay. So AI is giving tech investors an entirely new reason to pay attention to the Federal Reserve. We just spoke on that with the change of having Kevin Warsh come in. For years, mega cap companies with hefty balance sheets have been able to shrug off rising rates, which tend to weigh more heavily on smaller, less profitable peers. What she's saying there is before, right? Companies like Amazon and Microsoft, I mean, they had tons of money and a hefty balance sheet. They can deploy. They never really, I mean, they were completely wealthy companies, right? They didn't have to be so concerned about rising rates in their investments. But now they've got to pour so much money into trying in this AI race to not be left behind. Okay, and so that they're having to deal with that now. But companies were once that were once cash cows are depleting reserves and leveraging debt in their ambitious data center buildouts. That's making the group much more exposed to the cost of borrowing, and that's what we had touched on. Okay, now that they're using all the money that they had saved up, right, all of their free cash flow now when they now because they've got to go borrow more money, okay, instead of using their own, right, they're exposed to paying back interest and stuff like that. That's vital to the success of any business. And so right here, tech investors are not used to looking at rates. We had read that from Peter. She also mentions Warsh's first press conference, which we kind of covered already. The 10-year yield is trading at about 4.45%. I had thought that it was going to drop a little bit more than that after the so-called deal out in the Middle East, but there's more conflict out there still. I expect, in my opinion, right, my assumption is that, I mean, it's going to be a long ride with that still. Good news is good news, and market will react to that. But at the end of the day, I think it's negotiations are going to be ongoing for a while. Higher rates have always had an outsized impact on smaller companies as investors value them based on future profits. When yields spike and so-called risk-free rates rises, investors discount future cash flows, making them worth less today. Now, what Kate is telling us is that essentially the 10-year treasury yield rate, right? If you're not keeping an eye on that, keep an eye on that, because when it rises, typically the stocks will drop because it costs it the way that they evaluate and calculate the stock prices is based on how much money they're going to be making in the future, and they use that 10-year treasury yield as what they call the risk-free rate. And the reason why they call that the risk-free rate is because it's like, okay, if you're going to be buying treasury bonds, uh, the money that you're going to be getting paid back from is going to be from the federal government, the United States government, and who's got a better promise of paying you back and than the U.S. government? And that's why they kind of consider it risk-free. But anyways, keep an eye out on the treasury yields, okay? And that's why it's so important. The stock market practically is I mean, it really greatly impacted by the treasury yields. So keep an eye on that. OpenAI CFO Sarah Fryer has pointed to an ability to leverage debt markets as one motivation to go public. Reuters reported Thursday, citing two sources familiar with that matter, that bankers for SpaceX, which debuted on the Nasdaq last week, are preparing to meet investors about a bond offering at least 20 billion. So, uh, of course, I mean that's why OpenAI, which is ChatGPT, Anthropic, which is Claude AI, they're all looking to go public to raise money. Okay, and so that's exactly what SpaceX has just done so that they can actually pour more money into their investments, into their growth. Again, right? This whole not wanting to be left behind. A lot of these things are going on. The main thing, in my opinion, okay, I'd like to share with you all is what you've got to keep an eye out for as an investor. Now, this is what's important to you, right? Is you want to if you're going to be investing in a company, you want to make sure that okay, if they are pouring in their free cash flows. Okay, kind of like Amazon right here. Amazon is which has forecast spending roughly 200 billion this year, is widely expected to see negative free cash flow. So that means that okay. So with all these companies putting in so much money, okay, you want to see they're expecting to climb their revenue, okay, and climb their profitability. You want to check their earnings. You want to be on top of their earnings call to see if eventually the money that they're putting in is going to start bringing back returns. Okay, now that's one of the main things. You can check that out on like Yahoo Finance. Okay, just go under the financials, and you can see how their earnings, their revenue is actually trending. So I would like to do a video on that. I'm not going to do it right now, but in the future I'll do that. Okay. In fact, you know what? We've got a little time. Let's go ahead and just check that out real quick. I'll just walk you all through that real quick. Okay, so that's one thing. Okay, if you're investing in a company, you want to make sure that they've got a. I mean, if they're spending a lot of money in this AI build out, that they're going to be bringing in back revenue and profitability. You want to make sure that they ultimately end up having a strong balance sheet in the future, that they're going to be healthy. Okay, so let's take a look here. I'm going to go on Yahoo Finance here. Yahoo Finance. Okay, let's pull this up right here. We talked about Amazon. Let's go ahead and just pull them up right here. Okay. Amazon. This fiber optic internet's got to be faster than this, right? All right. So this is Amazon right here. Okay. So once you're here, uh, you want to go into their financials. Okay. Right here. And then, of course, if you have the app as well, you can pull that up. They've got the analysis on it where you can see like their target rating from analysts. So this is it right here when you scroll down. Okay. So we've got their revenue versus earnings, right? I mean, if you take a look right here, this is a Q2, quarter 2 of fiscal year 2025 for them. Okay, their revenue was trending up. Okay, this was their earnings down here. As I had mentioned, right? I mean, you want to see that as much money as they're pouring into their AI build, that eventually they start bringing in more revenue. Okay, and then you can also take a look into like their cash flow um, data as well. But I mean, I'm not too familiar with this right here, right now. So let's go ahead and that's essentially it, though. I mean, you want to take a look at all their financial reporting, okay? And if you drive around in Yahoo Finance, you'll find, like I said, they have their cash flow reports there as well, so you can see if they're continuing to use out of their cash flow and things like that. Those are just some of the things that you want to keep an eye out on if you're going to be investing. So next, moving forward, okay, we've got the Qualcomm CEO Cristiano Amon, and he wants to share some things with AI agents in the future. Okay, so essentially, we've got a few key points right here. Arjun Karpal sits down with the chip company chief on the Tech Download podcast, where they discuss the rise of new class AI agents linked to devices. Okay, we're talking about devices here now. Apps are going to change, Amon said, adding that agents are going to be the new app. He said that Qualcomm is working on 40 different designs of AI gadgets. These include jewelry, earbuds, cameras, pins, and watches. Okay, now that's one of the hot things that they're talking about, especially after the news from OpenAI, which is ChatGPT, that they are, they're building out some sort of hardware device for AI, which everybody is excited about, kind of like the Meta glasses and etc. So right here it says, imagine you're wearing a pair of glasses with built-in camera and a visual display. You're walking down the road and you remember you need to make a reservation at a restaurant. Instead of using your smartphone to research recommended spots, you talk to your digital assistant, who manages to get it done across various apps and sends you a booking confirmation. This is the new world of AI agents. That's what they're talking about right there. Apps aren't dead, he said, but apps are going to change. Those agents are going to be the new apps. So, some things to think about, right? I mean, I just wanted to share this article really just because we want to anticipate what's changing, how AI is changing our world, right? And because especially when we are investing, we want to be ahead of the curve, right? And that means that you want to look into these companies who are building these things that are maybe going to have catalysts, especially if you're trading on a regular basis, because spikes can happen. Catalysts will drive stocks up, and a lot of folks don't want to miss those spikes, and they want to have those gains. Okay, so something to think about. I don't know which companies are looking into building all these different gadgets that are working with Qualcomm. But I wanted to be informative to you all and share this news with you guys. Maybe you guys can dive into it. Drop into the comments if you guys know. That way, you guys share it with me. I can dive more into it. But eventually I'll take a look into it myself as well. This is new news to me. Although again, the Meta glasses have already been on my radar, and then the OpenAI stuff has been on my radar. A couple of other companies, large companies, are talking about hardware for AI. So I'm really interested in that and seeing how that changes the AI world. Okay, and then of course that's going to impact your investments, because all these material companies, okay, memory companies, semiconductor companies, we're probably going to end up using more of them. I'm just saying, okay. And then last tip of the day, okay, what you want to follow, okay, is you want to follow the spending. If you're investing, okay, you're probably not going to want to be investing right now in these companies that are investing large sums of money. You want to be investing in the companies that are receiving these large sums of company. Okay, and that's exactly why companies like NVIDIA, that the hyperscalers are buying from, the companies like Micron that are selling memory, that all these companies like NVIDIA who are building out their semiconductors are having to buy from Micron, and then of course Micron having to pay for the materials, etc. You want to follow that supply chain. Okay, that's the last tip I'm leaving you guys all with today. Good luck on your trading this next week coming up. Have a great weekend. My name's Curtis. Hey, give me a like. Click on that like button. give me a subscribe. I will see you all next time. Make it a great weekend.